For that. Thanks everyone for joining us for this boardroom briefing on how to sell or buy a practice without using a broker. As we go through the session, by all means, please, if you have any queries or questions that you would like to ask, you can either pop them in the chat box down the bottom, or conversely just pose the questions as we go. And that's probably that. And then so just, I suppose, to also give you an introduction, John, who will be speaking or presenting after me, I've known John for many years. John specialises in the finance side and is always a very good contact to have. We don't have any commercial arrangement. It's purely from a fact that I refer parties looking for finance to John because I know that he does a good job. So John will be with us a little bit later. Yeah, so we'll make a start. How to sell or buy a practice without using a broker. And really what I'm looking to do today is share with you, from an objectives perspective, share with you the process. So from woe to go, what that looks like, share with you some of our experiences and some of our war stories, and we've got lots of those. Also share with you some of the current market metrics or KPIs that are influencing price. And then also I'll share with you some of the terms and conditions that we're seeing in our transactions. So the next slide that we can see here, this shows us the overall transaction process. And so this takes, typically in a city or suburban firm or transaction, about 6 months from woe to go. And for regional firms, we like to allow, say, 12 months for that. What also highlights there is, and where our firm is probably a little different in terms of how we assist with the process, in that you see there the darker circles are obviously the decisions that are being made by the vendor. The light blue is what we're doing together. And then the goldy sort of colours are the steps that we're taking care of as your broker. So very hands-on from our perspective. And as I said, it's typically sort of that 6 months from woe to go. But we also need to remember that out the other side of the settlement, you're going to have an extended period of transition for the vendors. And so we'll talk about what that time period typically looks like a little later. So, you know, I like to say to vendors, if you're thinking about the process and you're at the decision-making process, you need to probably leave at least 18 months, if not 2.5 years from that time that you go to market to when you're going to have probably no involvement. And that's presuming that you don't want to go in, or you don't want to remain in a consultancy sort of capacity, because that's certainly a possibility these days. But if you're really looking to get out, you know, allow yourself at least 18 months in that process. So that first step there being the decision, obviously that's where you're up to at the moment. If you're a vendor, purchaser, obviously you've made the decision to acquire and move on, and we'll talk about what the market looks like shortly. But what I do like to say is you've really got to be committed to the process. You know, the overall sales process is very time consuming. It requires a lot of energy, it requires a lot of dedication. So to make it successful, you've got to really be committed with getting, you know, the right or a good outcome, and therefore you need to commit to that process. It's also important to know what the market's doing. You know, I recall hearing a while ago now that there was a practitioner that was looking to sell his practice for something like $1.80 and $1, and had sat on the market for 3 years. Funny enough, selling a practice is not overly dissimilar to selling property in some respects. In that if you don't get the I suppose the characteristics, the attributes, the approach competitive with market at the outset, then the practice is just going to sit there and it's going to go stale. So it's important to know what the market's looking like. It's also important to understand what your financial position is. And that's, you know, obviously part of the decision-making process, because there's no point going to market and saying, well, I need, you know, $3 million to be able to retire comfortably, and realistically your practice is only going to sell for 1.5 mil. Again, that's not going to get an outcome for you. So you're going to spend a lot of time and energy spinning your wheels. And then it's also important to find what you're going to do from a vendor's perspective in those post-practice interests. So I remember speaking with a practitioner, and he said, you know, of all the clients that he had who had retired, who had some really good post-practice or post-business interests, you know, they were fit and healthy and enjoying those interests, and those that didn't have any interest, there was a strong proportion of them that passed away within the first 3 years. So that's, you know, not overly attractive. So really, what are you going to do with your time after you're no longer involved? And as I said, if you want to have a consultancy, a part-time consultancy involvement, that's also a possibility. But is it for the grandkids? That's what we hear a lot of. You know, want to go and do some travel while you still can. What are those interests as part of that decision-making process? Moving on, it's also important to establish a fair market price. So that's part of the decision. And so that's through talking to someone like myself or others within the profession. So what is that market price and what's reasonable? It's also about finding out what the terms are. And again, these are the sort of things that we will speak about later on. You also need to have an attractive practice. So an attractive practice is a practice that and let's face it, if we've got a practitioner that's retiring at say 65, then the clients are typically about 15 years either side of that age. So it's important that we don't have a practice where there's a whole lot of clients that are older than the practitioner who have retired or looking to retire, unless you've got a financial planning division as part of that. You know, it's a practice where you're charging good fees, all of these sorts of things. A practice that isn't declining in revenue, that's another issue. And as I mentioned before, we have to be mindful of what those post-practice duties are. And then part of also the decision is, you know, when do you want to sell? Now, one of the most popular time for someone to sell is to go to market in January or February with a view to settle at, you know, 30 June, 1st of July. In actuality, it can be any time. So, but yeah, that's the most popular time, is to hit the market sort of January, February, March with a view to settle around the end of the financial year. So let's have a chat about what the market looks like at the moment. It's quite interesting and it's very interesting actually, in that pre-COVID, one of our colleagues, colleagues came out and did a bit of a study, and they found something like 52% of practitioners would be looking to retire in the following 5 years. Now, there wasn't a huge sample size, so if we want to say, you know, 52% is a lot of the profession. So even if we said it was 25% to perhaps be a little bit more conservative. This is around 2019. Then obviously COVID hit and nothing happened for the first couple of years. The accountants were so busy trying to service their clients, etc. No one had time to go to market. And then we started to see more firms start to come to market around sort of mid-2022. We're finding that the average age of practitioners is still on the rise. And we are certainly still seeing a reasonable number of practitioners in their mid-60s, say 70, even mid-70s, who are looking to get out. But interestingly, we're also now starting to see more firms with a spread of practitioners in varying ages that are also looking to sell out as a whole. And we'll talk about what's driving that in a moment. But yeah, so traditionally 65 plus, but we're starting to see more of a spread. And obviously that the rate of exit is expected to continue for the next couple of years. So if you're looking to sell your practice in the near future, the one thing I'd be saying is you probably want to start thinking about that earlier rather than being at the end. Because what we had expected to see was, as we saw more parties exit, we expected to see more of an equilibrium coming across the pricing, or a broadening of the prices being paid for practices. Now, for whatever reason happened, you know, January, February last year, whilst the number of people that were going to market had basically quadrupled since pre-COVID, there was also equally a strong number of people of varying sizes that have gone out and started to make acquisitions. And we'll talk a bit about what they look like as well shortly. The three main reasons we're hearing practitioners get out of the profession irrespective of age, is one, clients, and that's clients that have been difficult, clients that are debating fees, all of those sorts of things. So as a bit of a, I suppose, a flow on of COVID, there are clients that are more difficult to service, and practitioners aren't really enjoying that. They're completely over the ATO and all of those sorts of things. And also the staffing shortage is what's becoming problematic. So look, staffing isn't a new issue, but all of these combined are just making people say, look, I still love servicing a core group of good clients, but I'm over everything else. I'm over the admin. I'm over trying to manage staff. I'm over dealing with the ATO. I'm over dealing with difficult clients. So this is actually leading them to sell and get out, albeit that they're not necessarily looking to exit the profession. They're more than happy to remain in that consultancy type capacity, generally on a part-time basis. But this is what we're finding is really driving sales over the last 6 months. So in terms of pricing and conditions, it's still surprisingly a vendor's market. As perhaps wouldn't be surprising, the greatest interest is in city and suburban firms. That's not to say that regional firms aren't of interest. But that depends on the location. So if you're in, for example, Geelong, there's interest there. The Sunshine and Gold Coast always generate interest. Various parts, Port Macquarie, Coffs Harbour, Wollongong, Newcastle, those sorts of places in New South Wales, Queensland, Cairns, in addition to the two Gold Coast or the two coast centres. Interestingly, South Australia and WA are a more reserved market, and you don't typically see a strong number of practices openly for sale in those areas. But again, there's a good degree of interest in both city and suburban transactions in South Australia and WA. Historically, the most desired type of or size of transaction was around that sort of 300,000 to 1.5 mil. But again, in the last 6 months, we have seen more practices of more significant size go to market. So, for example, at the moment, we're representing a practice that's just under 10 mil. I've seen recently some quite significant transactions available in WA. So again, 3-4 mil, something like that. We've also got another transaction that's close to 6 mil. So, there are transactions of all sizes taking place at the moment. And we'll talk about who's buying those. Not surprisingly, SMEs, professionals, high net worth individuals, all of those sorts of people are the most attractive. There's not a significant interest in a whole lot of I returns. And, yes, there will typically be some of those there. They're generally mostly attached to other type of returns as well. In terms of purchases, many firms are finding growth difficult because of their aging client base. So one way to underpin that is to make an acquisition of a younger client base. Another thing that we're also seeing is not necessarily consolidators, but practices of a reasonable size say, right, okay, we want to get some geographical head offices, if you like, or key locations. So they're looking to buy in Brisbane, Melbourne, and Sydney. There are certainly the likes of some of the consolidators. Kelly Partners seems to be reasonably quiet at the moment. They seem to be focused more so overseas. Then there are some others out there. But generally what we're finding is, if it's $1 million practice, they'll look to bolt on 300,000 to 500,000. If it's a $3 million practice and, $1 million might work well for them. The real important key though is finding that, finding the right type of clients for the purchaser. If the purchaser is say 5 mil, buying a whole, 300,000 as a bolt-on is probably not going to be overly successful because they're not going to have the same type of clients. Another thing that we've also experienced in the last couple of months is the entry of private equity parties looking for acquisitions. And we haven't seen that before. So in addition to firms of a variety of sizes looking for acquisitions for a variety of reasons, we've now got the PE market also involved. So it'll be interesting to see where that continues to go. And then obviously with more substantial transactions taking place, you know, the PE type parties and those larger firms looking for strongholds in other locations are really going to be the purchasers for those more significant firms. So surprisingly, the market is more active than what I thought it would be around this time. So the next step to the process is once you've made a decision that you want to go to market, part of that is putting together the information. And I sent through an email to everybody last night. Hopefully everyone received it. And we've got some what we call a confidential practice information memorandum in this. And so part of being able to appraise the practice is having that information memorandum. And it's also important that information is relevant and accurate. This is used as the basis upon which someone will determine an offer, and it's also the basis upon which they will typically start to commence due diligence. So it's important that that information is correct and accurate and also relevant. So we won't necessarily go through page to page on that, but I think some of the things I saw was one information memorandum. You know, the prospective vendor had spent a page and a half describing their offices. Well, you know, 8 out of 10 times the parties looking to make an acquisition are looking to do a bolt-on where they're going to relocate the practice into their own premises. So, you know, a page and a half on the premises probably isn't relevant. Looking at the memorandum, what is important though is, you know, details about the tax lodgement details, about the fee stratas, about your top 20 client groups. They'll be interested in the age of the main contacts, the location, those sorts of things. Importantly, please don't use clients' names in these types of things, and also don't use staff names, at least initially, in these types of things. Reason being is, yes, you know, the prospective purchaser will sign a confidentiality agreement, hopefully early on, but we don't want the prospective purchaser, just as a risk mitigation point, being able to identify your clients or being able to identify your staff, at least initially. So I remember we did a transaction where the one of the prospective purchasers rang me 6 months after the transaction had taken place. They weren't the successful purchaser of the firm, and they rang me and they said, "Oh, do you think the vendor would mind if I actually rang and approached one of their staff about coming to work for me?" And I thought, yeah, I think the vendor will mind, because the staff had gone across to the purchaser, and they were a key staff member that had some client relationships. So it was fairly important that person stayed with the successful purchaser. Another thing to also keep in mind is in terms of those top 20 clients, if it's going to be really obvious who the client is, we don't want to change the information so it's inaccurate, but we don't also want to make it identifiable. So, for example, one vendor had a client in their top 20 that was a Baker's Delight in a suburb, you know, so there's only likely to be one Baker's Delight in that suburb. So we changed that to, I think it was a retailer, we just put Baker or something like that, as opposed to the name, and that made it a bit more anonymous, if you like. So they're the sort of things that you need to think about when filling this in, and all of these sorts of details are important. The more that you can add to this, the less, well, it's a good start to what you're going to have to produce in a secondary form. And it's important to understand for vendors that this information is key. You're not going to be able to hand over simply a P&L and say, right, you know, make me an offer on my practice. This is the financial performance of it, without actually telling or explaining anything else about the practice. So the collation of data is important. If we move on now to some of the KPIs, and we'll talk about, these will become evidence to why they're important. Obviously, profitability, particularly for larger firms. things like typical fees. I went to a practice recently to do an appraisal or a potential listing, and I looked at the vendor's information and basically said to them, you're charging half what the market is actually charging for your standard tax lodgements. And I said, it's going to be very difficult for you to get a transaction. I recall practice we were selling in Perth many years ago, and their charge out rates were 30% below market. Again, the problem there was the prospective purchasers either had to increase the rate straight away and risk losing clients, or wear write-offs for the first couple of years. So things, and also what we quite often find in sole practitioner firms is, and when they've had staff for a long period of time, is the charge out rates might be rather conservative compared to market, but we might find that the salaries are substantially above market, and that's in part due to the longevity of the staff member being with that firm. So these all make a transaction, or add some complexity or some challenges to a transaction. Client size, and we've spoken about the aging, the life cycle. If you've got a financial planning arm, you might not be as concerned if the clients are all heading towards retirement. But generally, accounting firms are looking for younger clients, a spread of ages, those sorts of things. Not everyone that's in the process of selling their businesses. WIP debtors, write-offs, they're all important to be competitive with market. For example, if debtors are at 90 days, it makes it very hard for the purchasers to come in and change those types of things to more reasonably competitive market KPIs. So it's important to know where your KPIs sit compared to market, and how that's likely to impact upon the practice and the sale. So now to get to one of the I suppose more exciting aspects of it, and one of the reasons I was talking about profitability being important is, historically, firms less than $1 million transact on a cents in the dollar basis, and firms greater than $1 million would typically transact on a multiple of EBIT. So obviously that's where profitability is going to come in to that particular approach and benefit the vendor. I'm saying that's historic because, again, as of January, February last year, it doesn't seem to matter what the size of the practice is. The offers that we're receiving are all represented as a cents in the dollar explanation or offer. Now, I don't know whether that means for those larger firms they're in the back end looking at multiples and those sorts of things, and just expressing it as a cents in the dollar. But that's what we're certainly seeing. So practices, we've sold practices last year that were 3, 4, 5 mil, and they were all priced on a cents in the dollar basis. And when I thought that range was going to get more elongated, at the moment what we're finding is, an average practice is probably around dollar for dollar, and a good practice is probably around $1.30, $1.35. Now, we have heard some parties talk about $1.40. I personally haven't seen it. I've seen as high as $1.35. And in terms of an EBIT, we're probably looking at 3.5 at the low end, and probably 4.5 at the top end. I have again heard of parties talk about 5 times. I haven't seen it. But what we have been seeing since sort of this time last year is those offers based on that cents in the dollar. And so the better firms are transacting at $1.20, $1.30. And also, though, we're selling one practice where we've had 6 offers, and on that one particular practice, that's ranged from 90 cents in the dollar through to $1.35. So you can't, as a vendor, guess or estimate where a prospective purchaser is going to see that strategic advantage in their practice. But it's really up to the purchaser to determine what that strategic advantage is. Naturally, all of this pricing is going to be driven by the firm's characteristics. So generally, that price is representative of goodwill, And then if they're going to buy plant and equipment, fixtures, WIP, etc., that's generally in addition to it. But again, where someone's doing a bolt-on, taking it into their practice, things like plant and equipment aren't as important. So if you, as a vendor, if you're thinking of getting out in the near future, please don't go and spend 50 grand on a new server or something like that and expect the purchaser to pay you for that, because they won't. And so that's typically the approach for a accounting practice. Obviously, multidisciplinary firms have a slightly different approach. So they'll pay so many cents in the dollar for the accounting side of it, and then if the financial planning side, now we've seen two times revenue, and I've said revenue as opposed to recurring revenue, and we've seen 2.2 times revenue as well. So in the marketplace, we're hearing some people talk about 2.5 to 3 times for financial planning fees, but that's recurring revenue, not just straight out revenue. So by the time, revenue and recurring revenue these days is fairly similar. So we're certainly we're not seeing from us in terms of multidisciplinary practices, we're not seeing that financial planning side get the 3 times that other parties are talking about. So we haven't personally seen that. What we also need to be mindful of in a practice that's very profitable is that there's a cap. So when I spoke about the high end being $1.35 or perhaps $1.40, we haven't seen anything above that. So in highly profitable practices, based on a multiple of EBIT, where you took out reasonable market salaries for the parties that run the practice, if that comes in at something more than $1.40, and we've had one where it came in at $1.50, the market will simply put a cap on and say, we're not paying you $1.50, even though I can argue till I'm blue in the face that a multiple of EBIT approach is reasonable. The purchasing market will not pay as what I think it is more than probably $1.40. So there is a cap. So, for those that run very profitable firms, what I say in this instance is great. You'll obviously receive the return on equity year on year from that highly profitable operation, but when it comes to selling, it's not going to translate to $2 and $1, for example. It's just not going to. What's also we're starting to see more of it, is that the asset versus the share sale. So historically, every transaction that we've done thus far has always been an asset sale. So the sale of goodwill, typically, and plant and equipment, where required, as opposed to buying the shares. And that's in part because of concerns around the risk of buying the company. And these can be mitigated to a degree. However, with some changes that have come through from the ATO, from the Tax Practitioners Board, those sorts of things, it's going to be interesting to see whether we now start having more share sales. It makes the overall transition a lot easier, and I'll talk about that a little bit later in the presentation. So wait and see on this. It seems as though it will make it easier easier if it is a share sale, as long as you can mitigate the risk of buying the company. So time will tell and see where we end up with that. So far we've made the decision to go to market. We've collated the information, put it together. We've come up with a price, and now we need to go and promote it. Now, for vendors who are selling themselves, that's a little bit more difficult. There's not a huge number of areas that you can go to where you can directly access the market for the sale of accounting or financial planning firms, and brokers won't typically list on their site where they're not actually the listing agent. So there are some online sites. Hard publications these days are virtually gone. We don't see someone going and putting rarely do you see someone putting an accounting practice for sale in the classified section of your local paper. So yeah, it's a little bit more difficult. For the purchasers, what I'd suggest is make sure you register with all of the brokers that specialise in transactions. Some of them will perhaps give you a earlier heads up than when it hits market, maybe not. But also, what I'd also suggest is doing some cold calling. So perhaps having a look around the area that you're interested in, if you're looking for a bolt-on around your area, and seeing who might be coming up to perhaps retirement age, and then perhaps going and having a coffee with them and seeing whether there's any interest. Because, whilst there is an increased number of practices that are for sale in the open marketplace, I'd suggest probably they're only a very small proportion of the ones that are actually transacting. So if you can get in first and get ahead, that might give you a bit of a leg up in terms of getting a successful outcome. Some of the online options that we have seen. So the NTAA has a section, I believe, where you can promote, and I don't know whether there's a cost to that or how broadly it's utilised, but we have seen it. Practice for Sale is one that we also use in addition to our website. The cost there is for $120. Basically run it till you sell it type process. And so that gets a good coverage. They put out a general email once a month, generally around I think it's about the 20th or the 22nd of the month. And the interesting thing there is, when I was saying that the number of firms that are publicly listed have quadrupled, pre-COVID, that was typically around 19, 20, 21 listings. It came out last week, and I think it was 81 listings or something like that. So it certainly is getting a lot more traction. You have some more generic websites like the business for sale ones there that I saw, and perhaps unlike our other colleagues, we do offer a section where someone looking to sell their practice or looking to buy a practice can put an ad on our website for a cost which they can then just manage themselves. So we do offer that self-promotion opportunity for vendors or purchasers. But otherwise, I'd suggest trying to find the specialised websites that for accounting firms wherever you can. So we've got the ad together. Again, think about when you're putting the ad together. We obviously want to promote the positives, those sort of things. We don't want to get sort of too involved with aspects that aren't going to be relevant or attractive. But as I sort of say to someone in terms of the confidentiality agreement, which the vendor will get from their solicitor, we like that to be provided very early on in the discussion. How do you feel about perhaps your clients or your staff hearing from just general chit chat that your practice is for sale? Again, how do you feel about providing confidential information without having that confidentiality agreement in place? So from our perspective, it's an absolute must. We have one that we obviously implement for our clients. One important aspect about that is that we use a code, so it doesn't actually use the firm's name. So I recall, funny enough, actually my accountant said to me at one stage, we made an inquiry about a practice for sale. They sent us the confidentiality agreement, and before we'd even signed it, it had the name of the firm that was for sale on it. So that was sort of beat the purpose of the confidentiality agreement. So for us in the CA, as well as the information memorandum, we don't actually specifically utilise the firm name for those confidentiality reasons. And in fact, I've had a cheeky Melbourne practitioner one time inquire about a practice. They were in the western suburbs of Melbourne, and the practice we were selling were in the eastern suburbs. And I rang and said, you're looking for another office, are you? And they went, no, we just wanted to know who was for sale. So they'd signed the confidentiality agreement purely for the goal of finding out who was for sale. So yeah, that was a bit cheeky, I thought. So I have a think about that. But for us, confidentiality is the first thing that everyone signs. So whenever someone makes an inquiry, we send out the confidentiality agreement, and that has to be signed before anything else takes place. And I mean by that is, I will answer some generic questions if someone phones and says, this practice that you're representing, where is it? I'd go as far as to say, perhaps the eastern suburbs or something like that. But generally much beyond that, someone has to sign one of those before they get any information from us. So you've gone and you've promoted the practice. You've got these inquiries. People are coming to you. if you're selling yourself, how and where do people respond? Are they going to, and Practice for Sale has a section where the identity can be withheld. So someone can make an inquiry without finding out who the vendor is. Likewise with us, the same thing can happen. You might have a colleague or your solicitor, for example, that people might respond through, but how are they going to actually respond to this? Also be aware that as soon as you go to market in the open marketplace, particularly if you have an attractive practice, you are going to be inundated with inquiries. So if you were to list on Practice for Sale, for example, we listed a small listing there last year, and we had something like 60 inquiries in the first 2 days. So at that point, we actually closed off our inquiry register because it was just getting out of control. It just wasn't possible to manage all of those inquiries. So, and that's the difficult part about it, because you also, when you get the inquiry, someone wants the confidentiality agreement quickly. So that's got to be ready. It's got to be, available in a timely manner. And so what we do is we manage all of these by putting the inquiries in an Excel spreadsheet. We put the contact's name, the firm name, where they are, when the confidentiality agreement was signed, when the information memorandum was sent, if that was the case. And, if they're wanting to, any sort of feedback, if they're wanting to have a meeting with the vendor, those sorts of things. So, yeah, as I mentioned, once they've signed the CA, we're on the phone to the prospective party if we're not familiar with who they are and what they're looking for. And only then are we then dispatching the information memorandum if it's relevant. Because there's no point, we don't want someone just having that information if it's not relevant to what they're looking for. So everyone's made their inquiries, and now what we're trying to do is qualify who's applicable and who's the most suited to actually have meetings with. Generally speaking, we find that it'll be one of the parties that was one of the first inquirers and the first to request a CA, the first to request an information memorandum. They will be really hot to trot. If they see something that they like, they will be on your back wanting to meet with you, all of those sorts of things. So, it's generally those parties and make an initial inquiry in those first couple of days that'll be the one that's really the most suited. What we're looking for also is to have a discussion around the similarities in characteristics and attributes between the two parties. So, as I mentioned, I spoke with a firm yesterday. They were quite a substantial practice, and they were talking about that they'd even be willing to buy, $500,000 in fees that they could bolt onto their practice. And one of the discussions was, well, how are you going to continue to service those clients with your, fee structure versus the fee structure of the smaller practice? So we're really looking at some similarities there, because there's no point coming in and saying, okay, well, we charge 50% more, so we're just going to wallop that on and expect the clients to stay and have the retention. So we're going to keep thinking about that retention sum as well. One of the questions we always ask is finance available? Now, I've probably been approached by at least 3 groups in the last 12 months that have told me they've got $40 million in money to buy practices with, and John will no doubt comment on this a little bit later. I can tell you one of them had great difficulty financing or getting finance for a transaction that they were looking to do through us, and that actually got delayed by about 3 months. So even those firms that think they've got the money or have pre-approval or something like that even exists, it's about also then being proactive. And so I think one of the things that was holding it up was the bank said that they wanted a copy of the contract for sale, for example. So as soon as you have the contract for sale, even if it's pending due diligence, I would be suggesting to the purchasers that they provide that to the bank to try and get the process going as quickly as possible. We even had, the last 6 months, whilst the number of purchasers out there and those that are looking to sell are competitive and significant, the last 6 months has just been absolutely difficult as nothing else for transactions at the moment. We've had a transaction not proceed due to not being able to get through the contract. We've had a transaction be delayed by 3 months due to finance. We've had a purchaser sign a contract for sale and not be able to get finance and not actually have a finance clause in the contract, so could potentially be open to legal action there. So the last 6 months have been really quite challenging in terms of getting transactions across the line, albeit the number of people that are in the market to buy and sell. Another core factor, and this is probably more so with services such as audit, or for those young practitioners that are looking to get out in the marketplace themselves, is, are they registered tax agents? Do they have their practicing certificate? If it's audit fees, are they a registered company auditor? The younger guys and girls looking to come out and buy a practice first off often don't appreciate that they're not going to be able to continue to lodge under the vendor's registration. Now, yes, they probably could do that from a risk mitigation perspective. I suggest that doesn't happen. So we say that you can't lodge under the vendor's registration. You have to have your own registration. So that's a question that's always worth asking as well. And then the last one we always like to do is Google them. Now, I found this out the hard way because we were just Googling some of the parties that had made inquiries. And can I suggest, if you Google a prospective purchaser and it comes up in a negative way on the first page of Google, that it's probably not going to do well as a prospective purchaser. Why? Because if you sell the practice to that particular purchaser and the clients do a Google as we've done and see what's been written, and it doesn't matter whether the information's correct or not correct, it's the fact that it has a negative slant on the first page of Google. The clients won't give that purchaser the opportunity to see whether they can continue to service them. So you'll have a strong turnover and therefore lose your attention. So that's always a good one to do as well. I can't overemphasize, however, and it's interesting in that I speak to a number of parties who have made multiple acquisitions over the time, and I say to them, what is the key factor to getting it right? And the key factor that I'm told is cultural fit. So the closer the two parties are and by that we're not talking about the ethnicity of the two parties, although that can be problematic, and we need to be mindful of how that's managed. But the greater similarity in terms of communication, how clients are serviced, all of those sorts of things are what's going to be most successful for the transaction. Now, it's a bit like as we talk about in the transition process, you want to be able to give them a warm introduction, and the vendor needs to be able to say in a positive manner that the parties that they're being recommended to go to following the merger or whatever it is are going to continue to service them well, and the vendor needs to be able to say that with honesty. And so the greater similarity in terms of fees, staffing, in fact, that I've often heard from purchasers that the best thing to do is come in, change nothing, and overservice the clients for the transaction to be successful. And by overservice, I mean service the clients to the same standard or better than what the previous practitioner had. So really, that cultural fit cannot be overemphasized, and that's really what makes the disaster, the difference between whether it's successful or not. And I think a prime example of that was a couple of weeks ago when I was having a meeting between a vendor and a prospective purchaser. The prospective purchaser was one of these PE entities or companies that are out there looking to acquire professional firms. And the meeting was just a disaster. It was an absolute disaster from the first 5 minutes. So the vendors, I asked them to give a bit of overview about the practice, its history, those sorts of things. we then asked the prospective purchaser to give some information about them. They weren't historically from an accounting background. They sort of fumbled their way through a few things. They really couldn't answer the questions that were being posed by the vendors. One key question, for example, that was asked was, what happens if something happens to the principals? How are you going to replace them? And keep in mind, this was a very large accounting practice, so just under 10 mil. And the prospective purchaser said, "Oh, I've got a 35-year-old colleague that can come in and run it." And I sat there and thought, wow, a 35-year-old colleague is going to have experience at running a $10 million firm? I don't think so. So there was these sorts of things that it just clearly was not going to fit. And so a meeting that normally goes for an hour 25, an hour and a half was done in 15 minutes. That's how disastrous it was. So we can't overemphasize that criteria, and that's really what you're looking for as part of these meetings. So in terms of the qualification process, as I mentioned, you really you're going to spend a lot of time and energy in this, so you don't want to mismanage it. And really what we're finding now is we've had one practice where we've had a couple of transactions fall over. We've had another practice where the negotiations have been going on for 12 months. And we've got what we call, probably transaction fatigue or seller's fatigue. It's been very draining, very emotional, and the vendors are at the point where, if it doesn't get done quickly, they're probably going to discontinue the process just to have a bit of a break because they're just so fatigued by it. So really important to manage that qualification process. There's no point in meeting with someone that doesn't have the ability, and obviously with those larger transactions, that's one of the things that I'm asking is, if you're looking to buy a $6 million practice, have you got the funding for that? Do you have the capacity to pay $8 or $9 million? If not, let's not worry about it. I also like to say, if you're not, and really what we're trying to do is obviously weed out all the tire kickers and the time wasters and those sorts of things. And part of our process is a bit different in that we like to do contract and then due diligence. And part of the reason why is quite often due diligence takes place earlier on in the process, and you have a lot of those time wasters and tire kickers that come in, are only sort of half committed to a transaction, spend a week looking through all your information and then decide, thanks very much, we're not interested. So that's, really what we're trying to do is get to a point where we're able to identify the most suitable party and move forward with them. And certainly if we like to say, the process is in part around what you're hearing, but also what you're feeling. So if you're not liking what you're hearing, then it's time to bail and not proceed any further and waste any more time with those parties. So it's about thinking about, in your heart, is this sounding right? In your head, is it sounding right? And I remember, we had another situation where we had some meetings for practice in Melbourne, and I'd spoken with one of the partners, but then the managing partner came in, and the managing partner was an accountant, a financial planner, and a real estate agent. So you can imagine that they had sort of a certain awe about them, a certain in the way that they carried themselves. And again, we sat down. The two vendors were very conservative. And we could just see within the first 15 minutes that this wasn't going to proceed any further. So cut our losses and ended it quickly. But really what you're trying to do is you're trying to get that qualification process done before you hit to the meetings. Because really what we're looking to do is, if you've had 60 inquiries, obviously you can't meet with 60 people. It's just not feasible. I remember providing some advisory work for a firm that was selling, and they'd said to me, we met with 16 people, 16 firms the first time round, and then they had secondary meetings with 15 of those firms. So if you think about it, an hour meeting at the minimum, there's 16 hours plus 15. So, they've blown 30 hours of their time meeting with parties that may or may not be appropriate or suitable. And so if you find yourself in that situation where you have got that many people wanting to meet with the vendors, what we introduced is an additional step where we ask those those parties to put forward an indicative offer, so a non-binding indicative offer, and that's just to make sure that they're aware also of market conditions, and that their offers are likely to be competitive, because yes, it's about the cultural fit, but also it's about getting a reasonable offer. So in terms of the meetings, I like to have these somewhere in a neutral location. So when we run them, we have facilities in various locations throughout the states where we can hold those meetings. And it needs to be somewhere quiet. There's nothing worse than sitting next to the espresso machine while the guy making the coffee's belting the daylights out of the coffee beans or whatever, and you're trying to have a detailed conversation. To me, these meetings, the initial meeting has to have purpose. So as I mentioned, the way we run these is we ask the parties the vendors to give a bit of an overview of the practice, its history, its services, its clients, those sorts of things, without mentioning names, etc. We then ask the prospective purchasers to also give us some information, a synopsis of themselves. And then generally there's questions around the information memorandum, as well as a number of other things in terms of trying to really walk out of that meeting going, having at least a fairly solid appreciation of whether the two parties could be a good fit. So it's more than that, just a simple coffee. And so as we're doing this, we're trying to limit this to probably no more than 8 meetings, and we would run those over a couple of days, one after the other. So 4 on one day, 4 on the other. And really what we're trying to do is we're trying to get everybody in the same place at the same time. And the difficulty is if you've got a meeting, or if you had a meeting with someone 4 weeks ago and now you've got a meeting with someone else in 2 weeks' time, human nature is there to wait and see what the offer from the person in 2 weeks' time might be, compared to the offer that you've received from the person you met with 4 weeks ago. So I'm really in that process. We're really trying to get everybody on the bus at the same time. So we're moving through this process so that we can have informed decisions. But keeping in mind, we only need one successful party to acquire the practice or to buy the firm. But likewise, I would prefer to sell it to nobody than sell it to the wrong person. And so they're some of the details that we share with our vendors. Is obviously as my facilitation in those meetings, I certainly go through and share the pros and cons of what I thought that was, what I think they're suitable. And we'll find by the end of those meetings, probably around half of them would have already been disregarded as probably not appropriate. But what I certainly do say to vendors is I'd prefer you to sell to nobody than sell to the wrong person. And so that's part of what these meetings are. And there may then be also subsequent meetings as well beyond that. But that first meeting should be a really good opportunity, a good hour and a quarter, hour and a half, to have some really good detailed conversation. So we've had those meetings. We've got through the end of those. Then what we do is, as part of this process, is I invite the parties that we feel appropriate to put forward an expression of interest in terms of an offer. And so that's part of forming that deal. We need to understand that there's always going to be compromise. And I've had 2 vendors that have said to me that, everyone needs to feel like they've got a win out of the process, because ultimately both parties have to work together through the transition period and beyond to get the clients to go from one party to another. Because essentially what we're selling is the right to continue to service clients from one party to another, and obviously receive the revenue that goes along with that. But it's a relationship. It's not a widget. So when we're doing these transactions, I like to suggest that we refer to them as mergers, if you like, or incorporations or whatever, as opposed to a sale, because people generally don't like being told that they've been sold. So that's typically how we recommend that it can be introduced. And all of that, if the practitioner's more senior, then it's going to be evident that they're going to retire at some stage. So that the message can be part of that. It's I'm planning for my future. For when I retire, I'm going to start to slow down. This firm's got some great resources. They work like we do. The staff will come across, so nothing will really change. Those sort of messages are really what we're wanting to see. So we need to appreciate as part of the deal that there is going to be some compromise, but we need to be really focused on, you know, the similarity in those attributes and the cultural fit. And as I mentioned, it's really, you know, if you've got a deal or a potential deal with a party that is a good cultural fit, look, you know, is going to be able to continue to service your clients well, that you feel good about, that you're going to be able to encourage your clients to stay with, then, you know, please proceed with them. Don't wait for, as I said, you know, what might come from someone in the future. You only need, you know, one successful purchaser for a deal to take place. So in terms of drafting an offer, we have got, again, another template there for you. I did, and really the template came about because I got sick of receiving offers that were, you know, basically X price and had nothing else. So there's nothing else there to consider. So, and it's also important that it's the closest to your best offer that you can do. So if we're receiving, say, 6 offers, and your offer is nowhere competitive with others, but you're reasonably similar in terms of cultural fit, then obviously the vendor is probably going to look at the higher offers and not consider yours. So it's no point coming back and saying, oh, you know, we could have done a better deal, when they've actually then proceeded to continue on with 2 or 3 other parties that were able to put in that best offer. Also, you need to be mindful that if your offer is too low, you're actually going to insult them. So if you're trying to have a negotiation, that's actually going to go out the door. And I can understand, and I remember working with a firm about what an offer should look like. And they were saying, oh, but we've got this problem, this doesn't work for us, and this doesn't work for us. And so we were thinking about putting this offer in. And I just said to them, I said, well, listening to what you've told me is you're going to put in a lowball offer for a practice that's not too bad, because you've got a problem with some of the attributes and characteristics of the deal or the practice you're looking to buy. And I said, that's not really fair. I said, I probably wouldn't put in an offer at all, because you're only going to insult them. So make the offer the best that you possibly can. And that template, that one-page template that you've got there that says offer to purchase a professional practice, that gives you some of the content that you might want to consider. It's by no means meant to be covering everything. If there's other points that you think that are important as part of the process, then please, by all means, include those as well. But they're the typical things that, you know, I go through and I look for when appraising an offer. So for those that are looking to purchase firms, have a think about that. That might help you with some of your offers moving forward. However you are experienced purchasers, you've probably already got that sorted. So we draft an offer and we put that forward. So far we've gone to market, had inquiries, fine-tuned a short list of parties that we've met with, decided which of that short list that we like and that we feel are most appropriate, and then we've got the offer to consider. And so in terms of terms and conditions at the moment, what we're typically finding is roughly 80% is being paid upfront, including deposit. And then the balance, depending on the size of the practice, is being paid over the following 2 years. So 10% at 12 months and 10% at 24 months or 2 years. We need to understand that the payment terms, whatever's paid at settlement, is not clawed back. So there's not an open-ended clawback. The clawback is linked or limited to that outstanding 20%. If it's a smaller transaction, you might need to be able to get to 85% or 90%, just depending on also the degree of competitiveness for the practice. But generally, we're seeing 80-20-20. Now, 80-10-10. Now, I have heard parties say, "Oh, look, they'll pay a third, a third, a third." Yes, they might be able to in private negotiations, but it's not happening in the common marketplace. As I mentioned, those clawbacks are limited to 20%, 10 and 10. Again, if it's a smaller transaction, they might pay the outstanding sum at 12 months. And generally what happens is, the clawback will be limited to that outstanding 10% at 12 months and that outstanding 10% at 24 months. On occasion, they may agree to a rise and fall between those two payments, or between the 2 years, but generally that's what's happening. In terms of restraints, now I'm not a lawyer, so I'm not providing legal advice. Please don't take it as legal advice. However, there needs to be reasonable restraints in it. Now, I've seen some pretty interesting ones that, where we've had something like 6 months on 5 kilometres. That was one end, and then the other end, I've seen a restraint that covered all of Australia. I'm not an expert, but from what I've seen, neither of those are going to work or stand up. So the lawyers really need to be practical about the restraints. Generally, what we see is that, and to a degree, purchasers are tending to say now that, firms service clients throughout Australia. And I mean, it is predominantly where they're located, but they'll have clients throughout Australia. With Zoom and all of those sorts of things, it's possible to service, clients that aren't close to you. So to a degree, the distance factor can be almost a waste of time. But generally what we see is, maybe up to 100 kilometres. It just depends on whether it's a regional firm or a city and suburban firm, 50 kilometres, something like that. And it's generally somewhere between 3 and 5 years. And it's applicable to the clients of that particular firm that are being bought, and perhaps any recently left clients. So that's where the restraints have been. WIP. As I mentioned, WIP's not necessarily always purchased, and quite often purchasers will say, I want WIP to be build out as much as possible in the lead up to the transaction. That may or may not be possible. It just depends on, for more senior practitioners that may only bill their clients once a year, and that's at the end of the financial year. If a transaction is taking place at some other time, they may find that difficult to do so. But we really want that WIP figure to be as low as possible. And then there's a couple of different scenarios that may be included as part of the offer. It may be paid for in addition, or it may roll over and be remitted back to the vendor once it's collected. So there's sort of the 3 different versions. The last one there of it being rolled over and remitted back is typically the most common approach that we see to deal with WIP. And quite often sole practitioners have a reasonable degree of WIP. And it's also important that it actually has to be recoverable WIP. So, often at times you'll hear firms have gone through and written off a whole lot of WIP at a particular point in time, and that's because they haven't done it on an annual basis. So, but it's important that gets as low as possible. I've had the worst case scenario that we saw was a transaction where the purchaser was going to pay for WIP in addition to the goodwill. The settlement took place. First day after settlement, the purchaser wrote all the WIP off, and that cost the vendor about $150,000 went out the door, and that was on an $800,000 firm. So you can imagine that all of our experiences and our suggestions are trying to mitigate or reduce the risk for our vendors. So that's why we make the recommendations that we do. In terms of creditors and debtors, they remain typically with the vendor. Staff entitlements are generally adjusted against the purchase price. Now, there are some times that I hear the vendor say, oh, well, I'll just pay out the entitlements or whatever. Again, not a lawyer, but I have had situations where the lawyers have said that can't happen where the staff are actually rolling into the new practice. So take some advice there, but there is an adjustment that is typically made. And on occasion, and something else that's important there is the adjustments, obviously, long service leave, annual leave, but we're also now starting to see adjustments being made for personal leave. And the tax rate is taken into considerations with those. And we're also seeing on occasions where the purchaser will recognise the original start date of the staff that are rolling over. So there's some of the things that we see. And then obviously the transition. So as I mentioned, the transition is 12 months, typically, if not 2 years, on a reducing basis. The person will generally be remunerated. On occasion, and it's interesting in that this used to be more common, but we're probably only seeing it about half the time now, is that the vendor will give a period of free assistance for the purchaser, and then after that time they will be remunerated for their efforts. And so that period of time I've seen have been somewhere between 30 and 100 hours. I haven't seen anything beyond 100 hours, and the remuneration has either been on an hourly rate, a daily rate, or pro rata full-time equivalent salary, just depending on what they were doing. But keep in mind that quite often the vendors aren't going to want to be doing hands-on work unless they're open to having a longer-term consultancy role. They're going to be wanting to transition the clients over as quickly as they can and then disappear over the horizon, so to speak. So the current challenges we're seeing in a transaction is with the ATO, Tax Practitioners Board, and obviously the issues around privacy laws. Again, none of this is legal advice, and I'm not recommending that anyone does anything illegal. What I'm simply sharing with you is what we see. So with the ATO, a full rollover of client information is relatively easy from the ATO's perspective. However, we now need the clients to reconnect with that new firm. And that has to be driven by the clients. It can't be done by the firm. And so we've seen purchasers have their admin staff, sometimes up to 2 or 3 months, working with the clients that have come across to reconnect with the ATO. So just keep that in mind, depending on how many client groups they have, etc. The Tax Practitioners Board has also said that you can't simply hand over all of the client files at the time of selling your practice, that you need to seek client permission to do so. So again, whilst it would be ideal from an IT perspective to simply dump all of the client's information from the vendor's computer to the purchaser's computer, this is in conflict with what the Tax Practitioners Board is saying. And this is why some of these things are perhaps raising the question as to whether it's better to do a share sale than an asset sale, because if you buy the shares in the company, everything remains in place. It's simply rolling over. Settlement happens day dot. You've just got different shareholders as opposed to anything else. All of the computer licenses remain in place. Everything still remains connected to or is in keeping with the requirements of the ATO and the Tax Practitioners Board. And then certainly we're starting to see more of questions around the privacy laws. Can a purchaser actually come in and review the vendor's client's files? And that's typically what takes place as part of the due diligence. Is typically the purchaser will want to review a couple of clients' files at least to I suppose determine the advice that's provided, the quality of advice, the quality of the files, those sorts of things. So again, there's a real conflict there, and I don't, other than I know it happens, and I'm not professing that it's necessarily ideal, but certainly my understanding from speaking with vendors and prospective vendors is there is that concern around the privacy laws and what can or can't happen in that respect. So it might be worth getting some advice. But yeah, these are some of the challenges that we're seeing at the moment. So we've got the offer, and it's our recommendation that you proceed with one party only, and we want to acknowledge that, and then we want to put what we put together is what's called a term sheet. So it's a very big picture, not legally binding document that just outlines and reconfirms what's being represented in the indicative offer or in the expression of interest, and so that all parties are reasonably clear on those big picture items, and then that's provided to the solicitor to help with the drafting of the contract for sale. The contract for sale have fairly standard terms, but this just gives them some guidance around some of the variables. Some people might also call it heads of agreement. You can do that. Generally, though, because it's non-binding, we just try and make it easy without having to engage a solicitor for heads of agreement or anything like that. So we're going to, after all the negotiation, one of the things that we do as a broker is, I get to play baddie because I'm the one that gets to go back and try and endeavour to get the best outcome possible for our vendors. But I must say, wherever a vendor has made a transaction purely on price, it has been a disaster. So going back to some comments a couple of slides ago where I was saying everyone's got to win and you need to be aware of what you're going to compromise of. There's some strong considerations as part of that. So we've accepted one offer, we've done the term sheet, and we're now going to proceed to contracts. Now, the important thing here is to get a practical lawyer who has ideally had experience in professional practice sales. As I mentioned, we've had 2 contracts now where the person drafting the contract has had the restraint period and distance as being 5 kilometres and 6 months. And you just look at that and think, oh God, this is going to be a waste of time. I've also had a lawyer who sent a contract for sale to the prospective purchaser with written on the top of it, vendor-friendly contract. That obviously didn't sit too well with the prospective purchaser and made all discussions from then rather difficult. So we find that if the terms are too outside the parameters of what's common within the profession, or they're overly onerous, it'll just kill the deal. Or it'll mean that the contract stage is going to take 6 months. And we had one of those situations recently. We had a practice that was started the contract process in February or March and actually then didn't settle until November of that year because we were going backwards and forwards. Runs up, obviously, the expenses for both sides, which neither parties are happy about. So, yeah, we just really need to be practical about that. We need to try and set some deadlines. I mean, ideally, in our experience, the contract stage, look, I'd say you probably need to allow at least 6 weeks, if not 8 weeks, if not maybe even 12 weeks to get through that process, just depending on the size of the contract and obviously the size of the transaction. And obviously, if it's going to be a share sale, that would perhaps also make that extend that period a little bit longer. But at times, whilst I've said to both parties, whilst at times we need to engage lawyers and take their advice, at times we need to say to them, look, we just need to get this done and need to be practical about it. Let's not have a debate as to who knows more about the law. So we want those to be practical. And also think about those points that might be contentious to you. For example, if the purchaser is asking you to hand in your practicing certificate, is that a problem? If the purchaser is asking you to give them your mobile phone number, is that a problem? All of these sorts of things. What terms are personally difficult for you, and then we just take the advice of the other general terms that are just commonly part of a transaction. So we do it a little bit differently in that we like to do contract and due diligence. And I've alluded to earlier why that is, and quite often some purchasers find that difficult. But for us, due diligence is not the decision-making point that you want to buy this practice. It's the confirmation that what you've been told and represented and provided with up until all of this process is actually what is actually there. So it's a confirmation, not a decision-making process. So, and it's also no point going and having due diligence or letting someone look through all your files, etc., if you're unable to reach an agreement on the contract. And we had that happen at the end of last year. We thought we'd pick the most appropriate party to proceed with for the transaction, and we spent about 3 months and many weekends and late nights trying to get, agreement around the contract. And in part, the stumbling block was that requirement to, or inability to, transfer client files as a whole without their authority. And that was the stumbling block that killed the whole deal. And so in that instance, there would have been absolutely no point having done due diligence if we, and they're not being able to reach agreement on the contract. So agree, you need to agree on the timing. Again, probably depending the size of the practice, depends on how long you spend doing DD, but commonly it's 2 to 4 weeks, just depending on size. And it's important to understand that the prospective purchaser has to be able to have access at any and all data that relates to the firm. So if they want to review client files, then they have to be able to do that. If they want to review your WIP records or your debtor listings or your tax returns or your BAS lodgements or whatever, they need to be able to do that. And that again comes back to where, the provision of that information is provided accurately, because we had one situation where the vendor had been asked for their BAS returns, and what they had done is they had amended them to take some personal items out of those returns, and then when they got the copy of the BAS returns off the tax portal, they didn't match. And so the first question was, of course, why don't they match? And then, even despite having provided the explanation, the purchaser then almost went through and, to the point where they were almost counting every single paperclip to agree, or to be confirming what they were actually buying. We like the information, we like the purchasers to go to the practice to look at the information, and we like all the information to remain there. Now, having said that, I'm less concerned with non-client related information staying at the firm. Like if tax returns, for example, that's probably not as important. However, probably the one time that a prospective purchaser was allowed to conduct DD before contracts, they came in, they had a full copy of all of the clients' names and contact details on a zip drive, and they had that, and then didn't pass due diligence. So they walked away prior to contract with a full list of the vendor's clients. So that's again why I like all that information to stay at the firm. Again, just these experiences, as I sort of jokingly say, in the information that we send through, is in Sydney here, we have stickers on under the bus driver's window that says, don't enter the window, don't enter the bus via the window. Now, it sounds a stupid thing to do, but obviously they've got a sticker there because someone's done it. So this is what we try to mitigate through our process. So the parties have agreed on contract, they've got due diligence. The next thing is we just need settlement. And so that takes place closely after DD. As I mentioned, many parties like to try and time this with 30th of June, 1st of July. It really doesn't matter. We've done transactions that have settled at all times of the year. So, and that's actually becoming more common. I mean, it's probably, prior to COVID, June 30, July 1 was a real date that people were focused on. These days, it takes place at any time. But importantly, it's when you're actually physically paying for the assets. So again, we had a situation where settlement was due to take place on the 1st of January, and then the purchaser had proposed to pay for the purchase price on the 31st of January. And I said, no. You've got a stump up payment at the time of the transfer of the assets. And generally, that's when you're then going to tell your clients and your staff if you haven't already. Now, staff is one of the biggest issues that we get asked about all the time. When should staff be advised? If staff aren't already aware that you're thinking of selling the practice, I would say you don't want them to be told until you've found the right party and they're at the end point of the due diligence. Because there's no point going to staff and saying, hey, I'm going to sell my practice. I don't know who to, I don't know when, I don't know what that's going to involve, because all that does is develop uncertainty with them. So if they don't already know, then I'd suggest, at the end of DD, and commonly what we're finding is prospective purchasers are wanting to interview the staff. And so that's the last thing that happens as part of DD. And you're certainly not telling clients that it takes place, that you're selling the practice or you're merging with somebody else, until settlement has happened, just in case it doesn't happen. It's like selling a house. You don't physically own it until settlement has taken and you've paid the sums that you need to. So we've gone through that process, contract, DD, with the best party. We've had settlement. And so we've then got those post-completion participation. And so here we want a really positive message. Generally, that involves the vendor directly contacting and meeting with their larger clients, just depending on the type of clients they service. But both parties need to have a really clear plan, and the plan needs to outline the expectations. Now, this can be hard because quite often purchasers will just say, look, I'm happy for the vendor to do whatever they want to do. And the vendor will say, well, I'll do whatever the purchaser wants me to do. You need to have, and this is obviously going to be well down in the process, but you need to have some clear understanding and some clear expectations around what each party is going to do. And look, I remember a purchaser even, they had the vendor on a bit of a retainer. And as they described it, the person was there for they'd come out whenever they had a party. They were the celebrity appearance sort of thing. So if they had a large client that needed some additional assistance, the vendor would appear. If they were having a firm gathering, the vendor would appear, but otherwise they weren't involved too much. But it's going to involve both parties, and there needs to be agreement around what that message is, how it's extended, and then obviously you need to get on and do it. And so generally the first couple of months are the busiest in terms of that communication piece, meeting with the largest clients, all of those sorts of things. But very important as part of that. So if we're talking about the difference between selling the practice yourself or a self-sale versus a broker, yes, there is a cost in using a broker. Generally, our fees are twofold. One is an upfront engagement fee, and then there's commission payable upon successful sale only. So there's no other fees, and commission is typically around 5% plus GST. The engagement fees just depend on the size of the practice, and likewise, for those larger firms, we are negotiable on the commission. So you do have that cost, but as the bonus of that, the broker has a broader market reach. In terms of the promotions that we run when we list a practice, it's through the Practice for Sale website, through our website, through our direct database, through our email newsletter. So we have a fairly substantive reach in terms of getting it out there. We also have the expertise and the knowledge and the up-to-date. And because we're arm's length, we can actually negotiate as that independent remove party, so that both the vendor and the purchaser, things remain amicable between them. It's me being the baddie as part of that negotiation point. And then obviously the confidentiality, if we're able to retain that until such point that we have the meetings really with that short list of parties. So and as you would have seen from our graph well back in the early stages of this session, we're certainly highly involved as part of the process. We really like to hold the hands so that we can get the best outcomes for our clients. But it's an education piece as well, from the knowledge and the expertise that we have. So that pretty much ends the session from me. Obviously, we've spoken about the overall process. I've given you lots of war stories. Hopefully, I haven't scared you off. I've also shared with you some of the typical KPIs that people are looking at, and we've also discussed the common terms and conditions that are part of a transaction as we go. Are there any questions at this stage before we perhaps have a short break and then John can jump onto his?
Thanks, Michelle, for once again inviting me to dovetail into your presentation. So it's always a pleasure to deal with you, and also thanks to Zoe for facilitating. So I'm a principal at a firm called Highline Finance in Latrobe Street in Melbourne. I did about a 20-year career in corporate and commercial banking, and nearly half of that time I specialised in professional services funding. So I've funded from, I guess, single practitioners right up to large mid-tiers, and that, across legal, accounting, of course, and financial planning groups. So I've also got clients in what we do here at Highline. Our focus is business finance. So I've got, holiday park groups, I've got pharmacy groups, I've even got an abattoir. But I do have a specialisation in this professional services funding. So, and to the point that Michelle made earlier about a client that she had, and I had already met with this client that told Michelle that that he had $40 million of in banking speak walk around money from a certain bank. That I knew straight away that would not be the case. So you've just got to be very cautious in dealing with banks about what you're being told by the sales area of the bank and what the reality is of when you need to go, how you go about accessing the funds. So it's critical it can delay the transaction, as Michelle's pointed out, if it's not set up as early as possible. So thanks again. If you go to the next slide, Zoe. Yeah, so obviously a question that anyone will ask is who's lending to accounting groups. So I'll take a step back. I'm going to present this from the point of view of the purchaser, but the information obviously that I'm going to go over in this presentation obviously can also be very highly relevant to the vendor and the transaction, and knowing what sort of information they're going to need to provide to the purchaser to be able to go and get finance. So because of the nature of the accounting industry being a regulated, conservative industry, all the banks have quite a strong appetite in lending to accountants. The difference being, however, is their approach. So the number one point of difference really is in the gearing appetite. So how does the bank consider the business? And what I'm talking about is the existing accounting business that you've got, and then obviously the business that you're buying and what that's going to look like in the future. So and then the gearing, the two key parts of lending obviously are gearing, or if you look at it from a home loan perspective, loan to value ratio, and then the capacity to service the debt. And they're obviously intrinsically linked. So when you're lending to a business, and specifically an accounting business, two key kind of parameters that a bank will consider are looking at a percentage of the fees, that they're the fees of the existing practice, as well as obviously the practice being acquired. And also another approach would be, and this is quite often used in financial planning scenarios, is a normalisation of EBITDA. So I think Michelle mentioned that in terms of where you've got certain practitioners that might be getting remunerated above what would be considered a market value. So what the bank will do is you can actually adjust the EBITDA for an over market value salary or remuneration that's going through the P&L. With regard to, again, some of Michelle's commentary around how practices, in a dollar for dollar, $1.20 and $1, whatever it might be in terms of fees, if the bank's looking at the gearing position from the perspective of fees, a percentage of fees, they're not going to fund. If you're going to go and do an acquisition at $1.30 on fees, you've only got the fees to extend against. The bank's not going to. If you want to pay what the bank would regard as over the odds for the practice, there's got obviously some sort of value that you can identify in there. But the bank, being conservative, is not going to be on board with that. They're just going to go back to the fees position of what the actual fees are, not what potential upside is for you. Another overlay, obviously, and again, this very much dovetails into everything Michelle's been talking about, is the operating efficiencies inside your practice, and as well, obviously, the practice that's being acquired. So how clean is the business being run? And then obviously feeding down to cash flow, because that's essentially what's going to pay the debt back. Yep, next slide. Thanks, Zoe. So what information do you need? There's one thing that I have actually omitted on here that I thought about this morning. It's if you can get a heads of agreement as early as possible. So it doesn't need to be the final document, but at least the broad parameters of what you're in agreement with the vendor of the practice. And the earlier you can get that, as well as some of these other items I've got listed here, and get those items to uh, uh, into a finance proposal, time is of the essence, because as we probably have all experienced in dealing with banks directly or indirectly, is um, that there's never a sense of urgency, and I guess having worked in banks for a long time myself, the credit risk area mantra is if you want a quick answer, the answer's no. So and obviously there's a reason why the banks need to be conservative, but they're also there's quite often a long list of information that they're going to keep asking for. So it's better to have the information up front. 2 years of financials and tax returns for your own practice, 2 years of financials, I guess, for the practice being purchased, as well as year-to-date statement for your practice and the practice being acquired. Then, depending on the size of the transaction, you're going to need to look at obviously a post-acquisition forecast. So a lot of this information you're going to want to know yourself anyway. So what's the practice going to look like in a year from now after we've done the acquisition? And the key thing in that is the assumptions. So that's what the bank will want to dig into, is that these assumptions. So you're going to grow by 5%, or is it 10%? And if so, and I'm talking top line growth, if so, am I going to have to employ more people? Is the operating structure sufficient to carry that growth, or even just to carry the acquisition that we're making? And what are the assumptions there? So, are we going to allow for some slippage in clients between, in the merger? You're going to need to look at, obviously, and provide to the bank at least a list of the top 10. And if you want to keep the client names confidential, which is understandable, you want to need to at least have the top 10 clients by revenue for the firm, maybe, and it'll need to correspond to maybe the last 2 years and year to date as well, in terms of how much revenue those specific clients are feeding into the firm. And is there an exposure risk there? Is there a concentration risk? So since we had the Banking Royal Commission a couple of years ago that were dragged through, the outcome, having worked in banks, pre-GFC and right up to the Royal Commission time, lending has become a lot more regulated and stringent. Now, this kind of lending that we're discussing here is not regulated like home lending, but the impact of the Banking Royal Commission is that the view taken is that the bank will apply very similar kind of stringency across commercial credit as well. And quite often, the question is, well, why do I need to provide my own personal? I'm a director at the accounting firm. I'm doing the acquisition. Why do I need to tell the bank what's going on in my personal life? Well, I guess from what the bank regards as a responsible lending perspective, they need to know that you're not trying to be a property developer on the outside, and they want to know about the pressure that you have from a financial perspective on the outside. What are your commitments? And you're not going to get away with not providing that information. So again, just provide it to the bank and then and move on. In the perspective of where you've got a firm where there might be 5 or 10 or more partners, that information can all be kept confidential as well, so it's not shared amongst various parties. So, yep.
John, can I ask a question just with that post-acquisition forecast? Is that something that the buyer or the seller prepares?
No, the buyer would
buyer will prepare it off the figures that's being provided, sort of thing, and the information. The buyer will just will prepare it off the back of the information that's being provided by the seller.
Yeah, correct. And I guess it feeds into why you're buying the property. So am I buying it just so I can add my fees to the fees and, 1 + 1 = 2, or what's the purpose? And do you have I think Michelle referred to financial planning. Is there share of wallet that you can see that can be expanded? Is there additional services you can provide to the new client base that are not currently being offered? So it comes down to why you're buying it. If you can't answer that yourself, then you probably shouldn't be buying it, would you? So, and you need to see some sort of upside, and it might even be, it's not a share of wallet thing. It might be economies of scale, or whatever it might be. You might have capacity to take on more, and that's the reason you're buying the practice. So just it needs to be prepared by the borrower, being the purchaser of the business. Absolutely. So again, in lending money, I guess it comes down to, I always like to say to someone, if I came to you and said to you, can you lend me $50,000? What questions would you have? And it's no different with a bank, right? So they're going to want to know what the money's being used for, what other debts do you have, all of these things. So, and when they're looking specifically at an accounting business, because any business is a dynamic, fluid entity and operation, I guess, we need to have some kind of understanding about what the business currently is, what it's going to look like in the future. So when, in terms of when your existing business are your partners all age 68, and if so, or is the business you're buying, is the person who's leaving and is taking a lot of IP with them? Is there someone that you can transition across to your business that's part of that firm that has those relationships? Because whilst you might think that you can go and form a relationship with a client that you don't know through an introduction, we all know that a relationship takes a long time to form. So all of those things, what's the risk of the client being dissatisfied and leaving? Again, concentration. How consistent has the revenue been of the business you're buying? Has there been any spikes in revenue? And with your own business operations, Michelle spoke of staff before, so that's obviously a key consideration. Again, all of the due diligence that goes into you looking to acquire, it's the same information that the bank needs to know. So one key thing, there's a quote that I was thinking of. It's a famous quote by Warren Buffett about it's kind of counterintuitive to what I speak about in terms of arranging finance, but a quote is that having leverage is like driving a car with a dagger at your heart. That it makes you drive better, but as soon as there's a bump, it can be fatal. So, how highly leveraged are you already? And do you have the capacity? Let's say that a key client leaves, or there's some kind of unforeseen issue. Do you have capacity to meet those bumps? And so that comes down to capitalisation, liquidity. So how often are funds taken out of the firm? The bank will want to have an understanding about that, and that'll come into your forecasting as well. So, do we retain? Let's say it's on a drawings basis. If you're in a larger firm, do we retain 30% of drawings in the firm to ensure that there's sufficient cash flow? Things like that. They're just risk mitigations that can be put in place. Capitalisation. So how does the firm work? Is it based on partners or directors or other putting cash into the firm, or is the firm borrowing money itself? I mean, there's all different ways to cut and dice how a firm's capitalised. So, and again, that's another question that is considered when you're talking to a bank. Does the bank have capacity to fund equity into the firm? So, yep. So essentially, the service we provide is taking that, negotiating with the various banks for the optimal outcome for the client. So we put together a full information memorandum, can often be 30 pages long, that provides a full analysis of the business and identification of risks, etc., that would normally be done inside the bank. We take away the sweat that the bank has to put into it and make it a transaction that they want to bank. So therefore, it becomes about negotiating terms and conditions that are optimal for the borrower, being the purchaser of the business. So again, we spoke earlier about going concern value assessment. So one key thing that feeds into pricing for commercial debt is a thing called probability of default. So how does the bank consider the probability of default on how does one bank consider it versus another bank? So they'll each have a different way of looking at it and put a certain risk against the business, and then that therefore feeds into the pricing that they provide. So the term, are you going to get 3-year money that you have to renegotiate in 36 months? Can you get 5-year money? Typically, money, the longer the term, the more expensive the debt is, but then you've got the surety of the debt being there. So capital structure, does the bank, will they do direct capital, partner capital loans? Is that something that the bank is going to offer if needed, especially when you consider about succession planning for your firm down the track? Because if you're going to go and put your banking with a bank, it's more than just about the immediate transaction that you're looking at. You want to know that there's going to be support from the funder, into the medium term at least. Where you've got different shareholdings in the firm, and there's going to be debt on the firm's balance sheet, can we limit the guarantees between various shareholders? The bank's default position will be that everybody is jointly and severally liable, but obviously that's not exactly a fair or equitable position. So capacity to negotiate that. Are they going to give you time? Are they going to give you interest-only terms for 12 months and allow you to, if you want that, and allow you time to bed things in? Another point of negotiation before you have to start making payments. Price is obviously a hygiene factor in terms of your funding, but it's not the be-all and end-all. So all of these things, these points of negotiation and other requirements such as reporting and therefore financial covenants that might be imposed. So again, the bank is looking to extend its position against a dynamic business, and so therefore that's what the reporting is all about making sure that the business is tracking along. And how often is that reporting required, if at all? And is there appetite for further acquisition? So if you're looking at, you've made a $500,000, $1 million acquisition, and you have plans in the next 2 years, want that bedded down for a further acquisition, those discussions would be had with the bank up front. You're never going to get a bank to ever commit to obviously saying, yes, you've got, they might say to you, all else being equal, we would be comfortable with a further acquisition, but it's going to be very much caveated with, we need to, it's not approved and we need to understand what you're buying, because you're not buying it. They're not going to just give you a blank check as the client that Michelle referred to earlier thought he had. And again, all of this dovetails into the business planning and structure. So, yep. How long does the process take? So, we'll put together an information memorandum depending on the availability of information, and then tender it out to various banks that we consider would be appropriate, and ask them, to collate, to provide their terms and conditions and obviously price. We then collate that all together. And then a bank will be selected to progress on a formal application basis. So again, price is important, but with commercial debt, all commercial debt, it's not the be-all and end-all. That they all will be broadly fairly similar, but it's all about terms as well. It's very important about terms, and does the bank have appetite for future assistance? And then the application process, 3 to 4 weeks. That's as long as all the information's there. But allow 2 months, I always say. Challenges. So where you've got a transaction, so if you're a sole partner firm versus a multi-partner larger firm, there's going to be different appetite from various banks. Obviously, the larger the firm, the greater the appetite there are from funders out there. Also, it comes down to the quantum of the transaction. So if you're looking at doing commercial debt against on a going concern basis, or a policy, professional services policy basis, if it's only 200 grand, you're not going to get a bank interested in a $200,000 sole transaction on that basis. Purely because of the potential for financial covenants, et cetera, and it's the bank's return on their position as well. So those things need to be considered as well. Michelle spoke earlier about earn-out terms. So if let's pretend it's 30-30-30 over a 3-year scenario, or 40-30-30, then there's a potential debt position that you need to fund in the future. So unless we can show the bank that position can be funded out of cash flows, there needs to be a discussion up front about, well, in 2 years' time, I'm going to be up for another $1 million. So that needs to be discussed as well. And does the bank have capacity for that? I spoke earlier about equity spread and guarantees, so limitation of guarantees depending on your equity position. One of the most challenging items that I've come across is getting the information out of the target entity, so the entity being acquired. So the financial information and depending on the size of the firm, the sensitivities around personal information being mixed in with commercial information. So, but just the clarity and availability of that. Yep. And that's just a bit on Highline Finance. So we've been around since 1998, we represent clients, and we like to maintain an ongoing relationship with our clients as well after, to help them with dealing with the bank. So thanks very much for that.
Thanks, John.
Any questions?
I've actually got one for you, John. One of the deals we were doing, the prospective purchaser suggested that the bank that they were dealing with wanted the individual tax returns of the vendor. Is that common?
Look, I mean, I would suggest that as long as you can identify with a payroll system, the only reason they might want that is to see, if there's a partner or key person taking a salary, and can we see how the remuneration is. There'd be no reason why they would need that other than to identify what remuneration is coming out of the firm. Yep. So it's an interesting point. So the point I made earlier around the World Post Banking Royal Commission, there's a lot of there's a real focus on compliance, and what it has done, rightly or wrongly, is it's moulded the bankers of today into compliance. Their focus is on compliance. So they'll say, oh well, we always ask for that, so that is needed, rather than hang on, why is it needed? It's about, I guess, a box ticking mentality. You're following a criteria, rather than the bankers. I find a lot of them are not being taught to think outside of that compliance sphere. And think about the actual risks and what we're looking at here in terms of a transaction. And look, that comes with experience as well. But yeah, that's unless you can, and that's part of what we do is say, well, hang on, why do you need that? Why do you need that piece of information? It's not relevant. But yeah, that's, yeah.
Thank you. John, does John have a question?
John Grieve.
Hi, can you hear me?
Yes, John.
I'm just a little concerned there. You said 30-30-30. We're talking minimum 80 up front. No one's selling on 30-30-30.
Yeah, I'm aware of that. I've done transactions in the past where it has been 40-30-30, and on the basis of an earn-out. So it was merely for a point of illustrating capacity for the bank to fund future debt. And obviously, if you're selling, you're going to want most of your money up front.
So will the bank lend it?
Okay, so the bank's got to be comfortable lending the initial 80%, and if there's a 20% in 12 months, the bank either has to be comfortable that you can afford that future debt that's on day one, or you show the bank that in 12 months you're going to have the cash flow to meet that 20%.
What sort of, let's say it's $1 million, easy number. What sort of pain would the bank want the purchaser to put in? Is it 20, 30%? But they're not going to lend $1 million, so 80%, 800,000. They're not going to lend them 800,000. What would be their lending ratio on that?
Yeah, so a rule of thumb, I guess, in any business acquisition, is 40%, 40% in by the of equity or cash. So, but if you've got a firm that's already a certain level of turnover and
I see.
you can leverage against that. It's like owning a house.
Yeah.
So that's how
Yeah. Okay. Thank you very much. Appreciate it.
no dramas.
Does anyone else have any other questions at this stage? No. Well, if you do, I'm sure John would be more than happy for you to reach out to him directly as well. Thank you, everyone, so much. Thank you for that, John. Thank you, Zoe, and thank you for everyone for attending. And we hope that you found that beneficial. Thanks, everybody.
Thanks, Michelle.